So it's not unreasonable to say, well, maybe we'll do it again. So 8 grand gold. Well, geez, if silver just were 2% of 8 grand gold, it'd be $160. Process, the arm wrestling process, we call it, which has actually been underway for a decade. Because the bear low in gold was in 2015 at $1,050. And MSA turned bullish in February 2016, a few months later, at $1,140. And nothing, when we look at annual momentum of gold, and even quarterly momentum, long-term metrics, in other words, not just the day-to-day, week-to-week stuff, nothing has changed our view. It's still in a bull trend. Yes, between mid-2020 and early 2024, gold was in a range, while silver and gold miners pulled back some. But it was really in a sideways range of about 20% extreme, more like 15% range. So it was asleep, but it wasn't negative. It was just paused. And then in 2024, we said it's going to wake up, and it did. And suddenly you went from 2,000 up to now 3,500. And yes, you did have a sharp pullback last week. Okay, a couple days. And we suspect we're at a point now in that gold advance that's more accelerated. In other words, rather than pausing and going dead sideways for 4, 5, 6 months, and bore the hell out of people, okay, or have a real sharp, deep correction, they're going to be briefer, shallower, and more teasing in terms of whether it's a valid pullback. The other attribute we've noticed in the history of gold bull markets, this is true with any market really, before you top in a real way, you can look at long-term momentum and see trend structures, not necessarily on price, but on momentum, where you can see like an uptrend that's been used too many times, or a flat floor on momentum. That something very obvious like that will smack you in the face, and you'll say, uh-oh, we better not have a correction now, because I'm going to blow the bridge over the River Kwai. It's so clear. We don't have that kind of structure. Gold does not have any kind of long-term trend structure on momentum that's anywhere near the market. And if you go back and look like at the 2011 high, we got bearish 3 months off the high. And gold hadn't dropped that much, but we blew a massive, very clear momentum structure. Price still looked okay. In fact, we caught a lot of negatives from our subscribers back then when we turned bearish in January 2012, 3 months off the high. And gold didn't collapse for the next year. It just went sideways in a dull range, but well off its high that it occurred in 2011. 2013, it finally crashed. But you've got to have the momentum structure. We don't have it. So we still view any pullback as meaningless, effectively, from an investment point of view.
Yeah, understood.
The phenomenon we think is going to occur now is that silver and the miners, which have lagged gold over the last several years anyway. To some extent, that's not true, by the way. If you really measure the miners more closely relative to gold, you'll see they ain't doing so bad. We think they're about to accelerate more than gold. Anyway, so I don't buy the stuff that, it's another top. They've said that 10 times over the last year. You don't top silver that way. If you go back in time, I'm not talking day-to-day double tops or anything like that, but we got one where we made a high in October at $35, and we had a sharp pullback toward 30, not quite 30. Went back up to 35 back in March. And then when that stock market break occurred, some investors decided wrongly that silver must go down, because if the stock market's going down, silver's an industrial metal, right? Okay, it's going to go down with copper and commodities. Heck with gold. Gold didn't go down at that time. Silver did. Gold dropped 5% or 3 or 4%. Silver dropped from $35 to $27.50. And most of that occurred in 2.5 trading days. 2.5 trading days of panic. And then you turn around a few weeks later, and we're trading $33.50 area now. The low of the month was 2.5 so weeks ago, at 27.50, and we're trading at 33.50. So we're $1.50 away from touching that 35 again. If you keep a point and figure chart, you don't see those very often anymore, but you ran up to 35 and then you put your zeros in for every dollar downtick. And when you dropped, you took out that low that had occurred after the October high last year. There was a low above 30, so it went to 31, back up to 35, and then when you came down, you blew all that out by going to 28 when you rounded off to $1. 29, 30, 31, 32, 33, okay? You touch 35 again, and we think you will. That is what's called a triple top or a potential triple top breakout. Silver does not peak with double tops, especially not triple tops. What it is a launch pad, not a top. You touch 35 again, and I would expect if you're short, your head will be blown off. Okay, so cheers. By the way, and momentum validates that statement about price. Momentum says, I'm primed to explode again, to come out of this pattern. Well, we do it the other way. We just simply divide price of silver per ounce into the price of gold per ounce. And if you go back 50 years and post on a bar graph chart, what is the highest reading silver saw each of those 50 years? Going back to the mid-70s now. And in 21 of the 50 years, silver traded at 2% or higher of the price of gold. So 21 out of 50, that's not unusual, in other words, to be at 2%. And in bull trends, like in the mid-70s, 1980 especially, and the 2011 bull market, silver got up to 3+%, the price of gold, even one time up to 6.5%. Okay, forget that, they call that an exception. But even in bull trends, it gets up to 3%. Well, we're in a bull trend, but silver's at 1% of the price of gold, which is very, in other words, if you like to buy low, and you believe in that, and it's pretty smart to do that, by the way, in silver. When it gets to 1% the price of gold, it ain't going to zero, okay? It's time to buy. And we think that if you get silver, which is slightly above 1% right now as we speak, you get it back up to about 1.1, 1.2. Pay attention. There's a structure on the spread chart itself. In other words, if you plot monthly closes of silver divided into gold, you'll see that there are two peaks over the last 3 years that reach 1.31. Okay, pardon me for being precise. You ever get back there again, you're going to blow it out. You're going to gush up to 2. Right now, we see the beginnings of that with this recent drop. And you get back over 1.1, I think you're going to blow out that 1.31 level and gush on up to 2%. So we're looking at that, you're right, we're looking at the spread as a trigger to get you up to norms. Even 2%, like I said, 21 of 50 years. 2%, so, well, I mean, what that says is, and by the way, that does not occur with gold going down. Mm-hmm. When silver spread increases versus gold, it's not because silver's flat and gold's going down, and therefore it's always because silver's appreciating more on a net basis than gold is. We don't think gold, and we think silver, so, you know, pardon me, I've said this 100 times over the last year. Gold in the last 50 years has had 2 8-fold bull moves. Bear low to bull high 8 times, okay? That'd be the 1980 high versus the 1976 low, the 2001 low to the 2011 high was 8-fold price gains. If we go 8-fold, it'd be $8,000 gold. Okay, that's merely doing what it's done twice before in 50 years, but under conditions that are far more explosive for gold due to monetary crises and government debt crises, and you name it. There's a whole list. Okay, so it's not unreasonable to say, well, maybe we'll do it again. So $8,000 gold. Well, geez, if silver just were 2% of $8,000 gold, it'd be $160.
Yeah.
Okay, what's the multiple times 33? Okay, where it is now. So you get the point. Yeah. The same is true with the miners. The miners are in the same sort of spread relationship to gold where they're when you plot the spread chart like of GDX divided into the price of gold expressed as a percent, it's right now pounding at about